Welcome back to the Daily Hunt, your morning dive into what's buzzing in the markets. I'm Ethan.
And I'm Brooke. It's Saturday, October 4th, 2025, and we've got a really interesting batch of data for you today.
Yeah, a busy morning for our AI, that's for sure. We've crawled quite a few posts, highlighting a good number of different stocks generating significant chatter. It's a real mixed bag out there, Brooke. Some well-known names, some emerging players.
Absolutely, Ethan. We're seeing a spectrum, some potential hot candidates if you're into growth plays, but also a lot of stocks that scream high risk, driven purely by speculative sentiment rather than, solid financial footing. So buckle up.
Let's kick things off with Plug Power Inc., PLUG. Our AI flagged it with quite a bit of chatter, and folks are seeing some impressive gains. One user was saying plug YOLO, and another bragged about holding it since 70 cents and selling around $3.90. That's a massive run-up. News is mostly positive, talking about the stock soaring and higher price targets.
Well, Ethan, while those gains are certainly eye-catching, the KPIs tell a different story. We've got a net profit margin of nearly negative 300% and an EPS of negative 2.28. This company has consistently been unprofitable, which, makes that current price near its 52-week high feel very speculative. And with a beta over 2.2, it's highly volatile. We've never rated Plug before, but based on these fundamentals, it's a stay away for me.
Okay, from high risk to another, Open Door Technologies, OPEN, which has been quite the roller coaster. The sentiment is generally bearish on the community, referring to shit SPACs. It's also been a frequent stay away for us, Brooke, for September 25th and October 1st.
And it's staying there. Open shows a net profit margin of negative 5.8%, negative EPS, and an astonishing debt-to-equity ratio of 346. That's a company drowning in debt and losing money. Plus, its beta is almost 3.6, so it's incredibly volatile. No relevant positive news to cling to either. Definitely a stay away.
All right, let's pivot to a heavy hitter, Meta Platforms, META. The sentiment is strongly bullish on this one. Users are calling it oversold and praising its AI game for driving ad revenue. Folks are expecting a run-up before earnings later this month. We rated Meta a buy on October 1st, so it's a frequent good candidate for us.
And for good reason, Ethan. Meta's financials are robust. A revenue growth of 21.6%, a stunning 39.99% net profit margin, and an ROE of over 40%. Its PE is a reasonable 25.78 for a growth tech giant. While its current price is just shy of its 52-week high, the underlying financials justify the bullish outlook. This is a solid buy.
Next up, Churchill Capital Corp X, CCX. The community is buzzing with bullish sentiment, with one post exclaiming, "CCX is just getting started, boys." There's a lot of excitement around its merger with Inflation, a quantum computing firm, and predictions of strong movement every week into 2026.
That excitement, though, comes with a stark warning, Ethan. We've never rated CCX before, but these numbers are concerning. An astronomical PE of 306, but an EPS of only 0.04. The price to book is actually negative 3612, indicating liabilities exceed assets. Zero net profit or operating margin. It's pure speculation on future potential. This is a definitive stay away.
Shifting gears to Rigetti Computing, RGTI, another quantum play. We've seen posts celebrating a 250% gain and even a 1,000% gain. The community is feeling some serious FOMO for this one, despite us rating it stay away yesterday, October 3rd.
And we're sticking with that stay away, Ethan. Those gains are from a ridiculously low 52-week low. RGTI has negative revenue growth, negative EPS, and is completely unprofitable across the board. Its market cap is nearly $13 billion against barely any revenue. The PB is 23.44. That's extreme overvaluation, driven by hype, not fundamentals. It's a stay away.
Okay, here's a curious one. IREN Limited, IREN. We had conflicting signals on this one in our data. One analysis leaned bearish, citing overvaluation, but another was wildly bullish, with users full porting sub 9 and expecting it to be over 100 by January. They're really excited about its pivot to AI infrastructure, doubling its GPU fleet. We've rated Iron stay away twice recently, on October 3rd, and it was a speculative gamble twice before that, so this would be an upgrade in sentiment.
It's a contentious one for sure, Ethan. While the AI pivot and GPU fleet expansion are compelling growth stories, the valuation is a huge red flag. A PE of 129 is incredibly high, and it's trading very closely to its 52-week high of $52.18. Plus, that debt-to-equity ratio of 53.05 suggests high leverage. For me, the risks of buying into such a high valuation, despite the growth narrative, are significant.
But the momentum, Brooke, users are reporting insane profits, and analysts like Bernstein are maintaining a bullish stance. The AI narrative is strong here. This could be a massive breakout story.
It could be, but that high PE implies perfection. Any hiccup in execution or a slowdown in AI demand could hit this hard. I'd label it a buy, but with serious caution.
Fair enough. Let's talk about Ondas Holdings, ONDS. A user claimed they made more this month than their yearly salary with ONDS, with the stock apparently up 440% in 3 months. They call it a rare earth play and a long-term hold.
A long-term hold with a 20.7 debt-to-equity ratio and deep unprofitability, net profit margin of negative 277%, negative EPS. It's pure momentum, Ethan. The stock is near its 52-week high, but its PB is 22.57, which is astronomically high for an unprofitable company. We've never rated Ondas before, but the financials scream stay away.
You know, the community's enthusiasm for NextDecade Corporation, NXT, was off the charts. One post, The Next Big Play, reportedly caused an immediate stock pump. Users are calling it a $100 stock in 5 to 7 years due to its LNG projects.
Ethan, this is a prime example of sentiment completely detached from reality. We've never rated Next. The post claimed solid financials and a debt-to-equity of 2.77. Our data shows a debt-to-equity of 285. It's unprofitable with negative EPS and zero net profit margin. This is a dangerous discrepancy. It's a stay away.
Okay, moving on to Applied Digital Corporation, APLD. The bullish sentiment is strong, with users talking about $11 billion in locked contracts for AI data centers and NVIDIA's investment in the company. The stock is up significantly from 19 to 27, with targets as high as 100. We previously had it as a speculative gamble on October 2nd.
Yes, and that speculative gamble designation still holds, if not leaning more towards stay away. APLD has an alarming debt-to-equity ratio of 110. It's deeply unprofitable with negative net profit margins and EPS. Plus, the beta is a staggering 6.59, making it incredibly volatile. While the AI narrative is powerful, the financial leverage and unprofitability make this extremely risky. It's a stay away.
What about Apple, AAPL? One post mentioned it as a past play, but shifted focus to other upcoming plays. It's definitely a blue chip, but Jefferies recently downgraded it due to foldable iPhone risks. We've rated AAPL a stay away twice now, on September 26th and October 3rd.
And for good reason, Ethan. Despite being a fantastic company, at a PE of 39 and a PB of 58, it's highly valued. It's also trading very close to its 52-week high. The analyst downgrade and the lack of strong current bullish sentiment suggests limited upside for new entries at this valuation. It's a stay away.
Let's discuss RICTech Robotics, RR. People are saying RR, never back down, never, what? Let it rip, rocket, and celebrating 200% gains. We rated RR stay away yesterday, October 3rd.
And that rating holds, Ethan. This stock shows negative revenue growth, negative EPS, and is unprofitable. The price to book is over 8, which is just too high for a company with such poor financials. Plus, there have been short seller allegations and over $800,000 in insider selling. That's a significant red flag. It's a stay away.
Finally, CoreWeave, CRW. Our AI picked up some chatter referring to it as a big multi-bagger thanks to its $14.2 billion Meta AI cloud deal. It's definitely a player in the AI infrastructure boom. We've previously called CRW a speculative gamble on September 27th and October 1st, and then a stay away on October 3rd.
Despite the hype in that massive deal, CRW remains a stay away for me. It's unprofitable with negative net profit margin and EPS, and a debt-to-equity ratio of 381 is astronomically high. The price to book is nearly 25. While the revenue growth is strong, its financial foundation is extremely shaky. It's a stay away.
Today's candidates for deeper analysis. So, to recap the morning's hunt, here are today's candidates for you to dig into further. Investigate as buy, Meta Platforms Inc., Meta, Toronto Dominion Bank, the TD, investigate as cautious buy, IREN Limited, IREN,
And for those with a higher risk tolerance who are looking at where the community sees the most upside potential despite serious fundamental concerns, our speculative gamble of the day is investigate as speculative gamble. NextDecade Corporation. Next.
disclaimer, and goodbye.
And that wraps up another episode of The Daily Hunt.
Just a friendly reminder that this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred.
The market is a wild place, and knowledge is your best asset. Be sure to check back with us tomorrow for more AI-generated insights into the market.
Thanks for joining us, and we'll catch you next time.